Welcome to the Property and Coffee Podcast. I'm your host, Matt Atkinson.
I'm Matt Skehan.
We'll be fueling your financial future one coffee and property insights at a time.
Helping you navigate the property market like a pro.
Hello, and what a pleasure it is to have your company on the Property and Coffee Podcast, where we're going to be fueling your financial future one coffee and property insight at a time. I'm your host, Matt Atkinson, joined by my co-host, Matt Skehan, and today we're joined by Phoebe Stanley, a Melbourne-based conveyancer, who will be sharing some of her expert insights and valuable experience also from the UK property market. Welcome, Phoebe.
Thank you for having me. It's a pleasure to be here.
Perfect. Before we get started, we're going to touch on what we will be covering today. So first up, what's been going on and chat around the barbecue and some news bites. Then we're going to be deep diving in with Phoebe and just understanding a bit more on her focus and what she does on a day-to-day. And from there, we'll be wrapping up the episode with some key actionable insights. So without further ado, let's get into it. So the topic we're going to be touching on today between the three of us is one that I've heard come up quite a bit this year and also in previous years, is the one of weather and its impact on property. Recently, if we look up the coast, there's been damaging winds, there's floods, there's obviously heat, and these all have an impact on people's property prices and potentially the insurances. What we want to look at today is just understand a bit more how those weather events may impact you, or if you're looking to buy a property in that area. So firstly, starting out with properties that are at flood risk. Maddie, what are your views on how that may impact someone that's looking to buy a property in terms of their value, and what should they be thinking about moving forward?
Yeah, great question, Matt. And I had a client recently, we sort of stood down from one in Seaford in Melbourne because it was in that sort of flood risk area. So obviously they're looking at future value, global warming, insurance cost is a big one as well. So I think you've got to look at it from a few perspectives as well. So even today it might be okay, but there's also that risk, particularly with global warming and things changing. I think people more and more are aware of it as well. So from a holding cost, but also from a capital growth as well, because if it's uninsurable or too expensive to insure, it's going to affect its potential and resale as well. So it's definitely something that's more and more topical in the current climate. So something we're aware of, and had a recent example where we stood down on a property that had ticked all the boxes, but it just, it was an unacceptable risk for our clients, which is absolutely fair and valid reason. So.
True. When you're spending a fair bit of money, you want to make sure whatever you're buying over the long term, ideally see that capital appreciation, and you're not necessarily finding out there's hidden problems down the line long term, which will be impacted by the climate.
So for you and for Maddie, what are the key financial hurdles buyers face when trying to get a mortgage for a high risk property? So like a flood zone or a high risk property. What do you see on the broking side?
So when banks come in and they're assessing your loan, they're not just having a look at what if you can afford to repay it. They also want to understand that what they're taking security of is a really good asset. So specifically around this question, they'll be looking at what the flood maps dictate, and if there's anything there that they need to be concerned with. They'll also be taking a look to understand, might be the recent weather events and what's gone on in terms of their consideration. So how this might impact you from a lending perspective, they might request that you increase your borrowing. Increase the deposit that you put down. In terms of the insurance that you're asked to put on the property may also be at a higher level. Alternatively, if there's no way they can mitigate their risk, they may just not look to fund the property at all. So those are probably the two key things to understand. Is one is in terms of the cash that you may need to put into the property might be higher than expected, but also from an insurance perspective, you need to be aware that those premiums might be materially higher than what you may be expecting, and to the point where we've seen some people say, look, we actually just can't afford the insurance premiums, and that might be a reason for them to walk away from the property.
If I came to an address with you, Maddie, and would you be able to tell me if it was a high risk rating? Obviously I know if something's closer to high voltage power lines or main roads, sort of that they get affected by, valuers and stuff. Is there any risk ratings from the banking side with these sort of weather events or flood events yet or not yet?
Potentially down in Victoria, we're not seeing it as much,
Yep.
but what banks will typically do is once we get the address or the postal code of what we're looking at, we can go and work with them and understand a bit more in terms of how they would view that and if there would be potential issues that may come up. So if there's an area that we're looking at where this might be a known issue, we find it's always good to be proactive and understand what you might be looking at. Even if a bank isn't, it's not an issue for the bank, it is also, good for that personal investor or client just to understand what is the impact on things like the insurance premium. So, those might skyrocket. It might be the reason, not necessarily the security that sort of makes the deal fall apart.
Cool.
Phoebe, would like to get you to weigh in here and understand, just from a legal standpoint, if someone's looking to buy property, whether it be in a flood risk area or just something to consider, what would you be advising your clients or getting them to think about when approaching this topic?
Well, we look at zoning. So at the moment, flooding is not a huge part of that. Bushfires definitely is. So I would say, depending on the results for the zoning and where the property sits, finance and insurance is definitely the key points, which is, probably where both of you come in as well, advising a client in that respect. But really just making sure, like you say, they can afford the premiums, especially if there's increased premiums due to being a high flood risk area or somewhere that's more prone to bushfires. And also just making sure that it's not affecting their finance, or, irrespective if they're not borrowing against the property, just making them aware from our review standpoint, because of course it could affect their saleability, and just because they're not borrowing doesn't mean they won't be borrowing in the future, or a future purchaser may need to borrow against that property. So just really making sure they understand the risks there, and from a financial point of view, it still makes sense to go ahead.
Perfect. Climate's going to be something that I think is going to be front of mind for everyone as we move forward. So definitely some of these points are going to be, I think, come up a lot more across the board in terms of when people want to buy property. They need to be aware of property value, the legal ramifications, and then from our side, potentially the financial risk and insurance in terms of how they would move that forward. Let's switch up the topic and dive into our guest segment. So, Phoebe, we're going to focus in and just understand a bit more from your side in terms of your business, your experience, and the type of clients that you're helping out from a day-to-day basis. Mm-hmm.
So let's dive in with the most important question of the day. What's your favourite coffee, Phoebe, and where can we find you drinking it in Melbourne?
Okay, so every day, a long black from Wall 280 in Balaclava. I'm very loyal to my local coffee shop. So
awesome. I think I've been there once with you. It was a beautiful little spot there.
It is,
Carlos Street. So lovely
I
spot.
rarely stray from that spot, to be honest. So
you got a good thing, keep it up, I reckon. So,
absolutely.
Yeah.
Starting local, I know just from previous conversations, we got a number of clients that will cross over in that more sophisticated investment space. They might be, sort of through trust lending, getting into that self-managed super fund. What are some of the non-negotiables and must-dos that you would speak to your clients about during the due diligence process in terms of they're looking to buy a property in Melbourne? What would you recommend that they dig deeper on to get really sort of assurance from a legal standpoint before they move forward?
Well, I think for these type of clients, the checks that are required from our standpoint at least go beyond the standard Section 32 review. So firstly, I think key to establish who is the purchasing entity. Is it a company? Is it a trustee for a trust? And just really making sure that it matches the client's intentions as well. We would also ascertain, for example, who actually needs to sign the contract and who has the authority to do that. We do see incorrectly executed documents a lot. So this is, in advance of them signing, it's a really good point to establish that and make sure that they go in knowing exactly who has the authority to sign. If there's a trust, also verify the trust deed in advance and make sure that the trustee actually has the authority to purchase the property is a really key point as well. Okay. But also I think at this stage it's a good point for you and I to cross paths as well, and just make sure that we're checking lender requirements and making sure that the trust documentation is in order and it's going to meet lender approval. There may also be additional searches that we want to carry out at this stage against the company for a corporate buyer as well. So I think just identifying this up front, it really just helps manage the risk and make sure that the client's intentions are met with with the structure that they're purchasing under.
Perfect. And rightly so. I know we work, it's great to work with conveyancers like yourselves, where, especially where there's a bit more moving parts, you just want to make sure that you've got everything under control as you move towards the finish line. And no one wants hiccups or surprises 24 hours before you need to get everything squared away.
Yeah, absolutely.
So just moving on there. So Melbourne CBD is full of high density living, Phoebe. So for high net worth clients buying off the plan or a high value strata property, what are some of the most significant hidden financial risks that you uncover? So like strata or sunset clauses, like just at a high level. I personally don't buy too many, but I know like it's an area, just something to be aware of.
Yeah, these types of properties, the reviews that we do are much more detailed, just simply because there are a lot of latent financial risks that are sort of hidden away within the documentation. So I think the key things that we uncover with those sorts of properties, firstly, underfunded sinking funds, especially with off the plan and new developments, because I think giving lower or sort of advertising lower owners corporation fees is fantastic because it creates the illusion of affordability, but in reality, is enough money going in the pot, so to speak, to cover those major repairs when they do need to be carried out? And the answer, unfortunately, is often no, which means that in the months or the years following settlement, clients will unfortunately receive either very steep increases in their levies or special levies being struck when repairs need to be carried out. So I think that's a key point. And on the back of that, also under budgeting for the running of the building or the development as well, because especially where there's a lot of amenities, gyms, pools, lifts, whatever it may be, it takes some time to really establish those running costs. It's not something that developers or owners corporations are usually aware of necessarily upfront. So again, as the property becomes more established, unfortunately, rising costs, special levels. Embedded networks is also something that we look out for a lot, because where management contracts or particular utility providers are locked in, it's that inflexibility can just cause, again, rising costs for the client, and there's no flexibility in that as well. So just something to consider. Also from a contract perspective, a lot of the time the developers will charge the upfront connection costs back to the clients as well. So if they're buying off plan, they can expect additional costs at settlement for those one-off fees for the connectivity as well. You mentioned sunset clauses, which is an interesting one because obviously they're designed to protect both sides in the event of delays with construction, but developers have been known to exploit sunset clauses, especially in growing markets. There is a risk that they can exercise the sunset clause or cause delays to exercise the sunset clause and resell the property at a higher price in the market. So we just need to really scrutinise those clauses and make sure that it's not particularly onerous on our purchaser clients, and just make sure that nobody is going to be left sort of stranded or out of pocket with minimal recourse.
You've made some very salient points, and just shows how important it is to get professional advice, I think, before you buy some of these as well, because there's so many things that at a headline sell the sizzle, right? And then you kick the can for later. So I think it's really important.
We will always scrutinise the budgets, management contracts, and of course the special conditions as well, and just really hit home with the client what the future costs and impact of that could be to them.
Oh, fantastic.
We all know, working in the industry, the auction element in the property space is an absolute beast in the Victorian market. I'd like to touch on what is the biggest risk an unrepresented bidder faces on auction day? And the second part to that is, speaking to someone like you, how would your pre-auction review help them mitigate that risk and just give them confidence to go into that auction and bid with clarity?
Yeah, that's a good question. I think an unrepresented buyer's biggest risk is just buying as is, where is. There's no cooling off period with auction. There's no ability to renegotiate after the hammer falls, so to speak. So, if they uncover issues with the property or the title or the contract itself, nothing can be done about it, which is why it's really important to engage a conveyancer before the auction date and make sure that they have reviewed the contract in the Section 32 and have made you aware of any risks to you. And that way a buyer can be confident and, go to an auction and bid boldly, knowing that there's not going to be any nasty surprises once they've purchased the property.
True. And when we speak to someone on finance and that, one of the first things we ask is, have you had someone review the contract, especially if not should be the only reason if you're going to auction, but you do want to make sure they've got a clean line of sight of what they're moving forward on. Yeah,
absolutely. And, a lot of people won't buy a property without going to view it, or perhaps, having other professionals go and so really a contract shouldn't be any different. It's can have costly implications if it's not quite right, and it's not a risk that I think buyers should be taking.
True.
I agree completely. So just shifting to business owners for a moment, for a client who is buying their commercial premises, how does the conveyancing process differ from residential? I imagine there's a number of differences, but what's some of the main or high-level differences from commercial to residential?
Yeah, it's definitely a more nuanced conveyancing process. There's a bigger focus on things like zoning, for example, and permitted use. We need to make sure that our client is legally able to carry out the business on that premises that they're looking for. Also, existing leases, we need to make sure that our client is fully aware of the terms of them if they're taking on a tenant, or if vacant possession needs to be given. We need to ensure that is the intention and is written into the contract as well. We'd also look at licenses, permits, compliance with local laws, so that there's a lot more considerations with commercial property, but also the contracts themselves are usually highly negotiable. So, whether that's outgoings or make good clauses, for example, GST treatment, things like that, it's all very negotiable. So usually it might take a little bit longer to get to the contract signing point, but there's a lot more involvement upfront in terms of negotiating the terms of the contract.
You just definitely can't just wing it, right? Like I think resi, there's definitely a lot more. The expertise that you bring and the value is really significant, and everything's negotiable. You said flexible, so it's an important point. So
Phoebe, switching tact, let's leverage and look towards your UK experience. So, having worked both in the UK and now Australia, what is fundamentally some of the key differences between the property in the property transfer process? Is it the gazumping risk in the UK versus the unconditional auction risk we see here in Victoria?
Yeah, so fundamentally the biggest difference is the point at which the transaction becomes legally binding. So in the UK, even after a buyer's offer is formally accepted, it's not a legally binding agreement until the contracts are exchanged by their conveyancers, which usually is 3 to 6 months after the offer is accepted, in some cases longer. So there are associated risks of gazumping during that period because nobody is financially committed and any party can withdraw without any penalty or financial recourse. So it does mean that there's a lot higher rate of transactions that fall through there. In Victoria, of course, because everyone is committed very early on in the transaction. It just means that, I think buyers, and especially where finance is involved, you can plan with confidence because everyone knows the key dates. It's just really minimises that risk of fall through, I think. I would say that's the key difference between the process.
Good insights. I mean, as you say, it's almost seems completely different in terms of markets and how they work.
Yeah, it is.
So so the UK is heavily weighted to freehold and leasehold, Phoebe. So Australia uses torrens and strata title. So for a client making their investment focus from, say, London to Melbourne, and I had a client recently who was going to engage to buy Melbourne but had some issues with that long chain and sort of didn't quite get together. Yeah. How do you clearly explain the differences between a strata title and a UK leaseholder? Like we've got a lot of clients that come from, we're all sort of, if you're Caucasian, from the UK. Like, is there any tips or?
I think the owner's corporation structure is very similar to a leasehold or management company structure in the UK. So in terms of the obligations, they're not too dissimilar, to be honest. The real difference, I think, and this is probably more so from a financial perspective, is not necessarily the cost, but how quickly the costs can be incurred. So in the UK, for example, if they need to raise a special levy, there's quite a stringent process involved to do that, and it takes quite a long time for those costs to be passed on. So for owners in the UK, they usually therefore have a lot more advanced warning of additional costs, whereas I think my experience in Melbourne and Victoria is that special levies can be struck quite quickly. So from from somebody who's potentially moving their portfolio or their focus over here, there are definitely financial considerations. And also not only with owners' corporations, but with land tax and with outgoings, especially if you have a residential investment property here, you're paying land tax, you're paying council water rates in the UK, the tenant pays all of the outgoings. So I think generally speaking, just the financial aspect here is quite different to what you would expect in the UK.
Okay, now it's good to know. As I said, there's some nuances that are probably some clients don't have the awareness of. So again, important to get good advice and get people who know what they're doing and can explain the differences as well. So,
absolutely,
Phoebe, I want to just touch on a point you mentioned earlier, and really it's around the time frames around the property process. Melbourne's obviously, as you would know, people want to get things closed out. It's quite quick, whereas you alluded to the UK can be a little bit more slower in terms of how that process works. So how does the time frames from each country essentially impact your essentially the client's ability to and give them certainty around executing the transaction? Specifically drawing a bit on your UK experience where you've noted, look, that might be a bit of a longer drawn out process and there's other variables that you need to deal with.
I think finance is a big consideration because in the UK, firstly, no offer is ever made unconditionally. So it's really difficult for clients and lenders to lock in interest rates, especially with protracted transactions, which unfortunately is the case a lot of time. Buyers are required to have their finance reapproved, usually every 3 or 6 months. So where they are, they are experiencing delays, it also comes with a further level of uncertainty because not only can the actual reapproval process itself cause more delays than there already are, but also there's no guarantee they're going to be offered the same product that they were the first time around. So where interest rates are changing as well, that there's no guarantee that they're going to have a good a deal as perhaps they had the first time, and potentially then they decide they don't want to proceed. Or, also if there's a change in their personal circumstances or, their income, whatever it may be, it might really impact their ability to actually have their finance offer extended. I think, I've seen Australia because Australia generally, but I think Victoria, everyone has very specific timelines in their contracts. So everyone knows how long they have to arrange their finance. When the settlement date is going to be. So I think working towards those more specific timeframes really plays at an advantage because everyone is able to plan with certainty, and hopefully there's finance clauses in the contract which we might touch on, but there's people have vehicles to withdraw if they need to, but we don't see that too often, to be honest.
That's great. And great insights, especially if someone's moving to Australia from a different country. Things might work at a certain way, like we highlighted with the UK, but it's important once you get into somewhere, Melbourne, or even if you're up sort of in Sydney or Brisbane, things definitely do beats in terms of from a time frame to a different drum, and typically that just moves a lot quicker. Yeah,
much quicker,
Are there any standard searches or due diligence documents in the UK that have no direct equivalent here in Victoria? And second point, like so this Section 32, is that something like that in the UK, or is there some people that need to be aware of just the nuances there, the differences in those documents?
I don't think anything in the Section 32 would be particularly new to a purchaser from the UK. There are similar documents that are provided up front in the UK as well. I think there is a much greater focus around outgoings here. A lot of financial information is not a standard factor in a UK purchase. So I think just really paying attention to the outgoings that are contained in the Section 32. In the UK, they carry out what we call a local authority search, and essentially it's just a record of all different areas of the local authority relating to the property, but also the area. So for example, planning and permits, also if there's, enforcement notices against the property or something in the area. It can be anything from sort of planning agreements between developers and councils, things going on with the highways and the roads at the property. So that search really should give you all of the information that you should ever need to maybe obtain from the council. There's no direct equivalent to that in Victoria. I think if a purchaser was interested in any of those relevant factors, they would probably need to either carry out more individual planning searches or approach the council for specific information. So that's something that I would be sort of mindful of coming across from the UK, because that information is not necessarily as readily available as they're probably used to.
Okay, no, it's great insights and again good tips there. So things I'm not familiar with, having not bought in the UK before, but it's good to know the differences and nuances. Thanks.
My next question is getting into the weeds a little bit around something I see a fair bit of, and I'm sure you would as well, which is around the finance clause in a contract of sale. if we look at clients where we may deal with high-touch lender approvals, or clients where they might have complex structures, how would you best prepare a client with a finance clause to make sure that they've got the appropriate legal protection when entering into a transaction?
Firstly, precise finance information up front. So how much do you need to borrow? And also let's overestimate that a little bit, because you can apply for less, but you can't apply for more if you're containing that information in a finance clause. So exactly how much do you need to borrow? Who is the lender or their entity? What is the realistic time frame needed for the approval as well? So as standard, we see 14 days a lot, but especially with more complex purchasing vehicles or more complex applications, is 14 days realistic? If it's not, let's go 21, 28, whatever it may be. Again, better to overestimate rather than run the risk of the finance clause expiring and, us needing to ask for extensions, and there's no guarantee that they will be granted. Also, I would say avoid vague terms as well. So, for example, purchasing subject to satisfactory finance. It's obviously subjective, but also we just need to really make sure that clause is watertight and that there's no room for argument later down the line if our client is relying on that clause to withdraw from a contract as well. So just very clear, precise and upfront information is the best advice I can give.
Perfect. One thing I want to highlight, and we see a fair bit of, is also on the time frame. When you're dealing with a normal loan, as you say, 14 days might be appropriate, especially if someone's got a pre-approval in place.
Yeah.
But we also see additional checks, understanding people's trust structures. That can take a lender a bit longer, and it's important to have that communicated to the clients. As much as everyone wants to get the transaction completed, those type of transactions do take a bit longer, and they need to just be made aware of that.
Yeah, absolutely.
So Phoebe, our high net worth and business owner clients frequently use complex vehicles like trusts, self-managed super funds, corporate entities to purchase property. What are some of the top legal errors that you see in the conveyancing process when these structures are involved? And is there any tips or things that you guys do to make sure that you minimise those errors?
Yeah, so firstly, incorrect execution of documents. So either incomplete execution, for example, the capacity in which they're signing or the authority that they're signing under is not stipulated in the signing clause. That's probably number one. Secondly, I would say mismatched names across documentation, because we see that a lot, and we need to make sure that everything is consistent. In the worst case scenario, inconsistent documentation can lead to either finance rejection for finance applications, voided contracts in a very extreme scenario. So it's really important to make sure that everything is consistent across the board. Also overlooking trust deeds and restrictions and rules that may be contained within as well. For example, if you're buying under a self-managed super fund, there might be restrictions against a related party purchase, or in some trusts purchasing property at all. So from our perspective, again, it all comes down to having the information up front before the contract is signed. We can then meticulously scrutinise the documents, the trust if they're purchasing under a trust, and just ensure that they are signing everything in accordance with the documents that they're providing, and just overall consistency as well.
I say our clients measure twice, cut once, or even sometimes 3 times, and particularly these entities, make sure you get the proper advice from conveyancer, accountant, broker, or combination. Just otherwise, it's hard to.
It's hard to fix after the fact, and it can cause delays in the transaction.
It's messy and stressful,
well.
and as I said, there's lots of other risks and ramifications. So important to front foot it. So
we're seeing in the process moving towards settlements, both the UK and Australia using more digital products in terms of to complete the transactions, thinking electronic signing of documents or digital ID verification. One of the platforms, PEXA, which is really popular, in terms of they've really helped move the needle in terms of getting that settlement process a lot more efficient and quicker. Have you seen, coming across from the UK, anything else that you believe Victoria or Australia needs to adopt, or items we could learn from the UK and bring into our processes just to make this smoother for clients and quicker as advisors in terms of being a part of that process?
Yeah, definitely. I would say PEXA and other e-conveyancing platforms here have undoubtedly changed the industry and really just streamline settlements, greater visibility for all of the stakeholders in the transaction as well, reduces errors with the documents that are being lodged at the titles office, etc. So it's a great system. I think the UK could certainly learn from PEXA and how well that's been received here. I do think in terms of more client-facing technology, the UK probably has a few things in play already that I'm not seeing yet in Victoria. Specifically, I've worked in a number of firms that are using client apps. So they download the app on their phone. Any tasks that they need to do, information being provided, can all be done electronically. So that just streamlines the information that's coming through to their representative. Also, it just provides them with more visibility. There's sort of key milestones that they can see. They have the confidence that the work is being carried out behind the scenes, because a lot of what we do is quite behind the scenes, and it just gives them the confidence that things are moving and that we're progressing well towards the settlement. So I think client-facing technology is something that could be brought in Victoria, certainly.
It's good to know. Well, hopefully the trend continues and they keep on implementing different technologies which make all our lives easier just operating in that property space. One of the last items I want to touch on, and this might be news to anyone that's listening here, but obviously in your space it is something that we know is coming down the line, is around the anti-money laundering, the Tranche 2 reforms, which are expected to bring real estate agents, conveyancers and lawyers into the reporting system. So if you could just touch on a bit more around what these are, but also what are the implications and obligations that you would see for your clients based in Melbourne in terms of what they would need to be expecting in the new year and how you would look to take them through that. Yeah,
absolutely. I would also just mention my experience in the UK. They've had a lot more strict anti-money laundering regulations that have been, certainly my decade in conveyancing. So I think, they're probably a lot further ahead in that process. I see Australia will be going the same way. It might take a number of years to implement, but I think that there's a number of things that clients can do now to get ahead, especially with the reforms coming in next year. So, at R.E.T, we're already implementing more robust onboarding checks with our clients. I think clients need to understand that having their ID, their company documentation, if it's a corporate entity, just having them ready and available. But I think most importantly, it's going to come down to source of funds. And that's something that they can liaise with their accountants and their brokers up front to make sure that they have all of the documentation that we will be requesting from them in due course. So really paper trail, origin of where the funds have come from. Often it's quite complex with company structures, etc. So I think they can definitely get ahead and reduce delays further down the line by just making sure that they've liaised with their relevant advisors and they have the documentation ready, because ultimately we'll need to be requesting that in due course, and we don't want to cause any delays in transactions if clients aren't ready for that request.
That's right. The property market moves quickly, and as you said, we would just want to make sure that there's no delays and you can get what you need in order to move everything forward. Thank you. That's a great insight, and I'm sure that's something we'll be seeing more of as we get into next year, and this is something that we see implemented a bit more broadly across the board and people start experiencing that firsthand. And regardless, it's just good to be organised in terms of getting into any transaction. Life is just that much easier for everyone involved, which we all do appreciate. Just to close out on you joining us for this segment is, what one piece of advice would you give a self-employed business owner or a working professional who is looking to make their next property purchase in Melbourne? What should they be considering as part of their next steps?
Yeah, so I think the key consideration is engage your advisory team and engage them early, because as we all know, things do move very quickly in property transactions. Yes. So instruct your conveyancer, your broker, your finance advisor, your buyer's agent, whoever it may be that you need on site, instruct them early and get advice early, because ultimately, deals move very quickly, and if you don't have the correct advice up front, it can be costly and time consuming further down the line.
Yeah, fantastic, Phoebe. That's some gold insights, lots of nuggets there. But that's all today for Property and Coffee. And just want to say thanks again for your time, Phoebe, and we've really appreciated it. And yeah, as I said, hopefully our listeners enjoy, and there's lots of little nuggets and lots of bits of useful information to help in that property journey. So thanks again.
I hope so. Thank you for having me.
Our pleasure.
If you would like to keep receiving property insights and golden nuggets from our guests, please do follow us and you'll get the latest episode released on a fortnightly basis.